and then when the memory wears off of how hard it was, I go to the next startup 5 years later. So I was kind of gone between corporate jobs and startups, but I have a real passion for this area. I've got a little over 30 years of experience in product launches, innovation strategies at large companies across a range of consumers. So I've done a lot of food bev. I also did apparel at Gap Inc. I launched this little concept called Old Navy, if any of you have ever heard of that, and a few others. And then Gary and I launched Bagel Bites, if that rings any bells from your childhood. So quite a bit of projects. So what I'm going to do is just ask each of our panelists, we'll go down the line, to give a brief introduction about themselves, and then we're going to do a few questions on CPG investing. Gary?
Gary Langley, out of Boise, Idaho, and have spent my career in consumer packaged goods at Heinz, Simplot, the JR Simplot company, and then most recently at a small startup, almost mid-sized now, called Happy Foodie. And my career has been focused, started in marketing and brand management, where I had the opportunity to launch Bagel Bites and turn it into a $100 million brand for Heinz. And from there, moved into business development and did projects for the Simplot company with Nestle's, Schwann's, General Mills, all of the major CPG companies, and then had a lot of fun the last 8 years running R&D, commercialization, and a little bit of operations, and just have a passion for consumer packaged goods, along with everything outdoors, avid outdoorsman.
Thank you.
Hi, everybody. My CPG journey started 25 years ago after my MBA. I used to work for Dairy Gold in those days. Right after my child was born, I took a break and launched my own company. I had a food business, and I was happy to meet one of my earlier friends who knew about the company. She came to the event when I mentioned it. But I am very passionate about, I had a successful company. I built it, ran it for 5 years, and had a good exit. I sold it to a larger company that has grown the business. It's been a great experience, and I'm connected to many local CPG brands. So I'm here excited, when Ron mentioned this, that we need to do a CPG event. I'm like, yeah, definitely. So I'm happy to be here and look forward to hearing from everybody. And I have a consulting company now where I want to help purpose-driven company with all the technology needs that they have, because I understand the critical part that plays in growing businesses. And especially in the CPG, there are lots of opportunities. So I'm happy to talk to anybody, help them grow. Thank you. Be purpose.
Hi, I'm Bob Wallach. Had a few different chapters in my career. It's been an adventure. Started as a creative, as a copywriter in an agency in New York, and then moved into brand management at what was General Foods, which became Kraft, which God only knows, Mondelez and whatever the heck else it is these days. Rose up in marketing there, similar to these guys, and then went on to become Chief Marketing Officer for Dannon in the 90s. Did that for a while, then went and ran the cracker business for Nabisco for a while, and then I always knew I was going to be an entrepreneur at some point, because I was the only one in my family that wasn't, and I got a lot of trouble at Thanksgiving for not being an entrepreneur, for being a corporate drone. So I took 8 years off, and I did 2 ventures, and long stories, very great experiences. After the second one, which was successful, my wife said, "We're done. You need to visit your family now." But I've always had a lot of heart for entrepreneurs and what they go through based on that experience. And from then on, I was in some sort of advisory role to some startup somewhere, even when I went back into corporate life, which I did. So I was at Kraft, Dannon, and Nabisco, went to ConAgra at that point, and realized once you've been an entrepreneur, it's very hard to go back. So I did that for a while. Then I found a mid-sized company here in Seattle, you may know, called Continental Mills, now known as Krusteaz. And I basically was a chief revenue officer and did strategy and M&A in addition to all the marketing there. Retired about 5 years ago. I'm pretty active now with angel investing. Gary and I are on a board together at the Alliance of Angels, which I've been doing for a while. I serve on boards of different size companies. One is $1.5 billion. The other one is actually in Boise. We should talk later about that, which is a startup, and the Alliance.
Great, thank you. Very excited, very honored to have all three of you able to take a half a day off and come and spend some time with us. So we're going to start off with a couple of questions around angel investing, specific to consumer and CPG. It's kind of a unique space in its own way. So we have a couple of questions, and then we'll open it up for audience questions. So as you're listening, if something bubbles up in your brain that you really want to ask our distinguished panel, please, we'll have an opportunity for you guys to do so. So the first thing is, it is a unique sector versus investing in tech or biotech or some of the other options. So if you were talking to an investor and letting them know what are the advantages of investing in consumer versus other sectors, we'll start with Bob. I'm going to put you on the hot seat just because you were last to go. But just thinking through, what are some of the advantages of investing in consumer sector companies versus some of the other sectors?
Well, a few things come to mind. I knew this was coming, so I jotted down a couple notes. I think there's more stability in this sector. The economy's good. People are eating. If the economy's bad, people are eating, and especially with consumer, what I would call non-durables. Whether it's cosmetics, health and beauty aids, people still need this stuff. Now, when you get into cars and washing machines and other things, it's different. But a lot of the sectors in here provide stability in an environment that balances out people's portfolios. It's an easy sector to understand. We're all consumers. It's dangerous a little bit because you have biases that you don't know about, but you can walk into a store and say, I can see what Grape Nuts is selling, and then you can get data pretty easily. There's SPINS data and IRI data, et cetera. So for consumer packaged goods, there's great data sources which can help you really understand the sector. It's got low capital intensity. A lot of companies, probably most of the companies here that have products are co-manufacturing, so they don't have to put the capital in. There's a point in time when you scale, you want to do that. But in the beginning, you can get in without spending a lot of investor money on capital, which is nice. And the fact that there's recurring revenue, you learn pretty quickly, because this thing got staying power, right? Because especially with the fast-moving goods in this sector, you get to see a repeat rate relatively quickly, and so you got something or you don't. It doesn't take very long. So those are my thoughts.
Anita?
Like Bob said, this is a recession-proof industry. People are going to eat, and we're all part of it. The best part is, if you create quality products, something that's unique, you're going to be successful no matter what. People, like I said, every day we're going to enjoy. So I think CPG has that steady returns. When you look at ROI versus other sectors where the possibility of success is very low. Whereas if the investor makes the right decision in the right companies that are set up well with their distribution, with their teams, with their products, the chances of success are pretty good. So for that reason, I'm positive and always looking for best opportunities in this space.
I would add just another little dimension to that. In addition, when you're doing something, 3 to 5 times a day, which is eating or drinking, or even, daily you're sleeping, that cycle of being able to get your product in front of a consumer, be able to get feedback, and then to be able to make changes, adaptations. You just don't have this same kind of lengthy process that you do in other areas. So in this space, you're able to innovate quickly, get feedback quickly, and if you're something that they need and like, your repurchase cycle is really short, and that helps build a strong business.
Great, excellent. And then one thing that I would add to that too is when people talk about investing in consumer, I talk about tech companies. You get those unicorns. You have 1,000 companies all chasing a particular industry, and you get one winner, maybe a second run, and then maybe a niche player. So maybe there's 3, maybe 4 companies, and everybody else dies. And then I tell them to walk down a beverage aisle in their grocery store and count. There's 40, 50, 60 brands in conventional. Then go down to Whole Foods. You can have in this category a wide number of winners across a range. And so you don't have to quite bet just on hoping you picked the right one in 1,000. Great. And we'll go to Sunita to start the next question. We'll just kind of mix it up here a little bit for excitement. And the second question is, there are, when an investor is looking at it, or if you're looking at a deal and considering it for investment or doing the due diligence, what are some of the investment criteria that you think are most important and potentially unique to this category as well for consumer products?
That's a very important question, and I absolutely think we all need, in today's world, to pay attention to the digital presence the CPG category brands will have. The reason being, there's just so much opportunity out there. As a startup founder, of a food company that was local to Seattle, I recognize the importance of having that broad audience, where if you have a shelf-stable product, you're literally able to reach across the country, across the world in a very short amount of time. So I that's one of the top criteria for me is how well are you taking advantage of the technology that's out there today, because the access to that consumer is pretty big. The second thing is, how well are you familiar with the product that you're selling, the team that you put together? That's very important to me. If I realize that passion, some people get started with their passion, but they also need to have some experience, some expertise in the space that they're trying to grow this business in. So those are two important things that I want to keep in mind. Thank you.
So I'll build on that. The first thing that comes to mind for me, obviously, is brand. Okay, that better? Yeah. Is brand. Perfect. Not always an easy thing to do if you're not a brand expert, but I think all of us have a sense for a brand that resonates. You got to be careful if you're not in the target audience. So making sure that, if it's a brand for 13-year-olds, you got to work a little harder to understand the brand, but then go find some 13-year-olds and ask them what they think. So brand comes to mind as unique. Obviously, all the other, I'm ignoring all the traditional team and,
right,
financials and all that stuff. You mentioned kind of domain experience. Yeah. And I would say in particular, you need a lot of domain experience because there's obviously a lot of aspects of business, but sales and marketing is very important. To have people who really understand how do these distribution channels work. It's not just about, getting viral, messaging out there. A lot of people get hung up when they don't understand customers and how they work, or distributors, et cetera. Supply chain is an area I look carefully at. How are you doing the manufacturing? How are you, do you have raw material risks? What's your backup? What could go wrong? Are your commodities, are you buying into commodities that could fluctuate? So just a lot of nuts and bolts about the product itself. And lastly, for me, what I've learned both as a corporate guy doing a lot of innovation and new products, as well as with ventures, timing is really important. Where are you on the wave? On the consumer adoption wave, on the customer adoption wave? Sometimes you want to be first, sometimes you want to be second. You very rarely want to be third or fourth or fifth. And we've all seen that. And so, really being thoughtful about, is this the right time for this product? And then is this product offer a unique value proposition that has some kind of insulation? In this business, it's very rare to find something that I would call sustainable competitive advantage, but at least temporary competitive advantage that's going to be a little hard for somebody to. That's why brand's so important. If you have the brand, and obviously if you're spending enough money to get the awareness up, that's one way you build insulation in this space. I've seen a lot of great ideas that never won because they hid their light under a bushel. So those are some things to think about.
And Gary, what are some investment criteria that you find to be important?
I would look at, is the solution really easy to grasp for their target consumer? Like, do they get it really quickly? And then if they do get it really quickly, is their need a one and done? Or is it something that will be a repetitive purchase? Because those are very different business models, and I want to make sure that we understand all of those attributes.
Great, thank you. The next question is sort of the flip side of that. So, when you're evaluating companies, what are perhaps some red flags that you see when you're doing due diligence that come up that would give you pause or hesitation around investing in company or recommending investments in that company? And Gary, you have the mic, so I'm just going to lead with, we'll just kind of start off with you.
So a couple of red flags that I'll mention is it too trendy? Is that going to be a short-term kind of, and where is it on that trend? Generally they're on the uprise, but is it soon to peak and then go down? So I just want to understand if it has staying power. And then another factor for me is, what are the alternative choices and the competitive choices? And where are they priced at? And what's that whole competitive set like?
For me, the red flag would be if somebody's pitching a lot and not showing the results. Just a business plan, grand business plan with all kinds of numbers, are something that many times investors take a look at it and get carried away, but don't do the back end research that's needed to actually see where they are, how they're selling. It's not just that you get the product in the store shelf, but how is it selling? That's very important too. Early consumer product companies take time to get established. So it's very important to have that knowledge of how they're doing in physical stores, if it's a physical product, if it's online, to read the reviews that are legitimate. Understanding the company is very important. Not just go with what the founders are pitching, but if the numbers don't make sense, that's a total red flag to me. Thank you.
Yeah, there's probably a long list, but do I have time to tell one short story?
Go for it.
Yeah. So there's a couple of concepts that the quick tale I'm going to tell illustrates. One is, do people really understand their consumer target? And a lot of times entrepreneurs, they're just not, they're not like these guys, or many of you, where they've got domain experience. And that doesn't mean they can't be successful, but you kind of got to know what you don't know and find resources that can help you navigate that, either in the beginning or as you scale the business, as you take on new challenges. So consumer understanding is very important. And the other thing is kind of knowing. There's a saying among angel investors, is it oxygen, aspirin, or jewelry? Have you guys ever heard that one? Which is basically oxygen, you need it to survive. I got to have this product. It cures cancer, I want it. Versus, this would be helpful if I had it in my life. It adds convenience or something else. I can probably live without it, but I like it. Versus jewelry, which is just fun. And there's nothing wrong with any of those things, but obviously it's an easier sale and it's a more critical sale on the oxygen side. So I am working with a company, and I was initially a consultant, and we were doing a branding exercise. They didn't really understand their consumer. It was a plant-based butter company based in Boise. You probably know who I'm talking about. Yeah. And they had done not a stitch of consumer research, and they were operating on feel, and they had done pretty well for a long time on that. But they thought their consumer was, a young millennial that really cared about, social issues and plant-based and vegan and all that. And that indeed turned out to be part of their consumer audience. But what we discovered when we did the research is about half their audience was old farts like me who were worried about cholesterol. And all of a sudden, you went from aspirin or jewelry side of the world to oxygen. I gotta have stuff like this to live. And by the way, it tastes great and I can use it, and it checks all the other boxes I need. But that was incredibly powerful. We completely shifted our approach to the marketplace, to the branding, et cetera, based on a couple of insights that came out of research. So I really look to see, is this just you talking to your neighbors and your friends, or have you really learned about it? Now, in the beginning, you form hypotheses, but I like to see companies who figured out a way inexpensively to test those out.
Great, that's an excellent story. Thank you. And then the only thing I would build on in terms of red flags, and it's building a little off of Sunita's point in looking at the numbers, is, and this comes a little bit with understanding domain experience and Bob's point about understanding your channel, is when the ramp rate is too aggressive and they don't understand the timing in the channel. As an example, I could get somebody an appointment tomorrow with a Safeway buyer, and the buyer could love the product, but they reset only once a year. The reset isn't till next August. So they can literally go, I'll take it August of next year. And so understanding, and that's the grocery channel, but every distribution channel, more and more as people build efficiencies in their supply chain, they're really building in these cycles. And if you don't understand that you have to somehow survive, great, they want you in all stores. How do you get through the next 11 months? How do you roll out? And how does that affect the mix of stores you may go after? Do you, aim for some of those big companies? So that's the thing that I look at as an understanding of the fundamentals and be able to see some level of understanding the patience and the pace that consumer can take to build. Okay, and our last question then, be thinking, because I'm going to open up to you guys next, so I'm hoping we get some good zingers up here for some questions from the audience. But the next one is understanding, kind of building on that idea of of the challenges that the consumer companies have in scaling. And this is something all of us have been in startups, and we've advised startups. And so one of the biggest challenges is from the product side, from the people side, from every functional area of your business. You can have the great idea, and I see companies that they just burn out, flame out. And in consumer, that tends to be an especially high rate for the scaling challenges. So I don't know if anyone even has a preference for this. I know, Bob, this is something that's a passion for you, but maybe Sunita, do you want to start with scaling? And then we'll
Sure. I have a perfect example. When I did my food startup, I wore every hat. I was a creator. I was a manufacturer. I was a distributor, and marketer. That was because I was bootstrapping my business, and it was small business. But the biggest challenge is the distribution, option that many CPG brands don't realize. You're not going to get picked up by big distributors for a long time because they want to hear your name from different people. So people go into this business thinking that they have a great product, they have investors, they have money, and they're going to get into all the stores and boom, boom, boom. It doesn't work that way. And that's a realization that many people realize after they've already invested in the business and see the hardship that comes with it. So always keep those things in mind. You have to be ready to roll up your sleeves, jump in, and do what you need to do. If it's hiring somebody on your own, to get started, do that, or use different methods. And then in terms of your supply chain, that's a very critical thing. Finding, if you're going the co-packing route, making sure that you've vetted the company that you're using, make sure they don't have a record of mismanagement, mislabeling, whatever. There are many things that could go wrong. And also their stability in terms of how long have they been in business. Are they stable? Because if you scale and if you have contracted with somebody, it's very hard to switch. It's not easy to find other contractors. So be careful in your growth projections, to be careful who you've partnered with, what their capacity is, and based on that, plan your expansions.
You go to Gary. Well, and so Gary and I have been through more than pack. We had one last year, nightmares, and so they're all great at the beginning.
I was going to say nightmares that keep you up at night. So a couple of thoughts on scaling up that I think are critical too. Oftentimes an entrepreneur is really fascinated with one particular channel of distribution, and retail is a really sexy one, but that may not be the right place to go. And so you have to match that up with your own supply chain needs. What are your longest lead time ingredients? What are the minimum order quantities of those kinds of things? Will it support a large scale? And seasonality? What's going to drive the peak times that your products are going to be used, and can you flex that manufacturing? If you're going the co-manufacturing route, not only do you have a manufacturer that's got to be able to be an expert, because like the last one we did was a supposed expert, but we found that we quickly had to become the experts for that company because they really didn't know what they were doing. They just had all the equipment. And so you really have to vet them out. And then if you're in an established co-manufacturer, how big of the total business are you? Generally, you're small, and your needs are critical, and your needs generally happen really quickly. So how are you able to pivot with your co-man in order to be able to meet? And so part of this is matching every single one of those puzzle pieces together to be able to come up with a strategic plan that really can be supported and executed.
Yeah, these are all great points. I'll build on this. Two things I'd like to add. One is, as you start to scale, that means you're starting to be successful. That means you're on the radar. So your competitors are going to react at some point. Hopefully not for a long time. Hopefully they're sleepy. Hopefully it's highly fragmented business. I've been on the other side where some little guy got in my space and I said, I don't think so. And, crushed him. So it can happen, and it's ugly when it does because you don't have the resource to fight back. So think about competition, think about competitive reaction when it's going to occur, be prepared. And that kind of leads to, that's one of many things that could happen. It's very important that you are not a checker player, that you're a chess player. And you plan out different options, different moves, different scenarios, do a lot of what ifing. What if this happens? What if that happens? What if my costs go up? What if this customer goes away? And what am I going to do if? Don't run out of money, which means those scenarios will say, hey, worst case, I'm going to need this much. If you over proliferate your SKUs, what's the implications for your manufacturing costs and cannibalization? So play the scenarios all the way through. Time spent doing that is going to be incredibly valuable over time. And the last, I guess, a third point, know what you don't know, surround yourself with really bright people. If you're going to get investment, you're going to need a board. Make sure you've got people on the board who are value added, not just names and faces, but people who will roll up their sleeves and dig in and care about the business the way you want them to and the way you need them to. Create an advisory board. You could pay thousands of dollars for consultants that you get for free on an advisory board. Very few entrepreneurs take the time to do a real advisory board, not one you put in a pitch that says, I've got all these famous people that say they'll be an advisor, but a working advisory board that you give assignments to, that you tap into, because their networks alone will save you time and money like you wouldn't believe. So we can talk more about that at a break if you want to hear more about how to do that.
Oh, excellent. So we'll open it up now to questions from the audience. Yes.
Hi there. My name is Kartik Ram. I'm a former investor in direct-to-consumer companies, Shopify being one of them. And now I'm at US Bank doing lending for CPG and a bunch of other startups that are scaling and need growth capital. 5 years ago, this panel would have had a lot of D2C names and digital native brands. Now the conversation's gone right back to traditional brands again. What's your view on the investability of your kind of cohort of companies that are coming up the ranks and doing testing and growing versus a digital company that kind of tries to buck the trend and circumvent distribution channels and go direct to consumer?
Okay, so because a lot of the companies here today have, you say that the ones that were in our cohort or our grouping today, a lot of them are.
5 years ago, a panel like this would be Warby Park or blah, 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 blah. And now you're talking, bagel bites and things. I mean, it's a very different conversation. And it seems like old is new again. So I'm curious about the investability of that versus this.
Okay, so traditional channel focused companies versus more like D2C only or D2C as primary. Okay, great. Anybody want to jump in on that one?
You guys hard for it? I'll start. I think what's happened is it isn't a switch back; it's a blending. And you can't be a brick and mortar distribution company and not have an online presence. Products are being delivered, online, ordered online, working with our customers. Even if you don't have your own active online, you're going to have one with them. So from my view, many people, depending on the situation, are starting out online. It works in some categories better than others. I think for food, it's a little harder still, but it can be done. So I don't see them as a different, but really just we caught up, if you will, the brick and mortar folks.
I don't know if I totally agree with your analysis that people are starting now, in store and then going digital. The reason being with what happened with COVID, many brands did not have that opportunity. Many stores have closed, or the opportunity to break into brick and mortar stores is harder versus getting started digital and then coming back is what I'm seeing. And I'm also interested in letting a lot of those brick and mortar stores to know that there's opportunity online to get online, especially if they have shelf stable products. Even the perishable products that are based with the shipping options now, there are a lot more people that are able to do that. I've seen a company that does ice cream online, and the dinners that go online. All of these companies have that option today because of what we see in the shipping benefits.
The only thing I would add is I spent about 16 years in the agribusiness segment as well, and that agribusiness cycles, it just does, and it's going to go, and depending on which part of it is how big those or the troughs are between the cycles. Right at the moment, I think consumer brands reflect stability, and that was something that was really lacking in 2020, 2021. And so I think we're going to cycle through. We're going to just continue to do that. And so you try to read that and prepare for it and invest that way.
And I would add to that, I've seen an interesting shift in the economics. I think the prevailing assumption was launching online is cheaper. And as it's become more and more competitive, I was doing some modeling last year for a pet food company, shelf stable, let's launch on Chewy. And we looked at the dynamics of online. As those online retailers have become more powerful, the economics and requirements on there have gone through the roof. So it used to be cheaper. But then now as it shifted away, I found that the traditional brick and mortar, to be more competitive, have been a bit more aggressive, a little bit more open to entrepreneurial brands, a little bit more willing to shave 5 points off their margin because they want to make sure that they continue to win in that space. So I've seen a little bit more of a balance out there where I think people assume, and then you also look at the economics of driving trial. One of the biggest things, kind of just building a little bit on the backing up a couple questions to red flags, but building on this point is the cost of acquisition and being able to evaluate that. If you can get distribution in 2,000 Walmarts out of the door and you're getting what I call a trip over volume, where people walk down the aisle and go, oh, that looks good, and they put it in their cart, you're getting a lot of velocity versus what it takes to drive now, what the cost it takes, $75, $100 to drive someone potentially to your website to make a purchase. So I think economics are starting to balance out a little bit more, in addition to shipping costs, which is a challenge. I'm blown away that the ice cream guys are doing it. That's quite that's a commitment.
Yeah, having tried that.
Great. Next question. Yeah, Joe.
Hi there. I'm curious how the consumer product industry thinks about synthetic biology in terms of now and in the future, over the next few years, and if big brands are investing in it, and just a general thoughts on it.
Yeah, I mean, there is a lot of work being done in that space. I know, a lot of it's, I've seen trade organizations trying to explore that. Like they did a project with the Dairy Board where they're looking at printing milk, and part of what I have seen that's interesting is in industries where there's an allergen or an issue or something they're trying to isolate, either in a good way or in a bad way. So now you can dial milk up or down. You can take out the things that make people sick in milk. You can also dial up the tryptophan and have sleepy milk. So, there's they're looking at it, I think cautiously, but I've seen a lot of it being done more at the university level, trade organizations that have the bucks to invest in those things. I haven't seen as much on the industry level, but see what you guys
Scenario, I spent 6 years in Simplot's biotechnology group where they were doing genetic modification using the crop's own DNA. And so I did a ton of consumer groups around those issues. And one of the big three fast food companies is taking their first shipments of a genetically modified French fry in the next month. Quiet, because it's the potato's own DNA. It happens to solve a whole lot of other issues around pesticides and water usage and a bunch of other things that have a positive consumer benefit. So when you're able to find a way to do something that is more consumer friendly, understandable, the initial reaction was still, what the hell are you thinking with a genetically modified potato? But science ultimately wins, I think. And I'm one of those that's like, there's so much that it brings to the table, especially when there are some diseases like the canker rust that's killing the orange crops, where there is not a traditional method to be able to solve that quickly enough to be able to have orange juice on the table for the next few years, that you have to turn to. Hawaii found that they were having similar kinds of issues around, it was pineapple. And they had to turn to a genetically modified version in order to save the industry. So it depends. Consumers are still going to be afraid of it. Consumers are still going to have questions about it. But ultimately, hopefully the science wins.
The big companies have budgets for crazy stuff. So they'll play around with it, even if, and you know, by the time it becomes real, then they'll, you know, and they have to put real money into it, they'll ask the consumers what they think and they'll figure it out. And there are, you know, right now it's negative, but, you know, again, oxygen, aspirin, jewelry. If you can't ever have a pineapple again, it starts to be interesting. The Department of Defense has just issued a grant, I was reading the other day, for the development of microbes that consume plastic, and then you can then turn those into food. It's early stages, but crazy stuff's going on. These shoes I'm wearing are completely compostable, made from algae and hemp. Okay, and consumers have no problem with that. It's not GMO. But I mean, so as we start to see more alternatives to some of the problems that we're facing, more of this stuff will be acceptable. But you know, it is fraught. It is fraught. You know, so it'll be a kind of, I think it'll be like 2 steps forward, 1 step back kind of experience.
Yeah. Okay. Anything else? Okay. Yes.
Oh. Yeah. So I heard trends and timing. So I was wondering, from a founder perspective, is it a lot of just intuition on how to catch on those trends and timing? And then from an investor perspective, how do you evaluate, like, yes, this is a trend, this is going to stay, or no, this is a dud?
Can I start with that, since that was one that it's very hard unless you have deep domain experience to really suss that out. That's where you got to go talk to people who are in it and who are future kind of thinkers, who think of the world that way. And don't just talk to one, because you'll get different opinions. But I mean, it's true for entry. And by the way, it's also true for exit. If you hit the window wrong on your exit, and all the strategics have picked their dance partners, right? And you're like, well, my company's as good as the 3 that just sold. Yeah, but the 3 that just sold got sucked up and they don't need you anymore. So think about it, both entry and exit. A lot of what you have to think about is, what is the consumer seeing? What is the customer seeing? If you're the first one or the second one on the shelf, it's going to make a big difference. If there are already five on the shelf, your competitiveness and uniqueness has to be much crisper. If you're the first one, if you're the first plant-based burger, right? We've seen this. You're going to kill it. When the 3 others come, you better sharpen it, better get better tasting, et cetera, et cetera.
I totally agree with Bob on the timing. It's not just the trend, but if you're first or early creators, you have a better chance. But you're looking at it much further. Maybe you're catching the trend towards the downturn. So I think doing your own research, not jumping into conclusions quickly, and having a vision of how are you going to pivot if things change, are all the things I would keep in mind.
I think you also asked something about intuition. That's right. Oftentimes an entrepreneur has to trust their intuition in order to be able to start. But then you've got to go and get more facts or data or something else in order to be able to understand if you can continue to trust your intuition or if you need to pivot, like you mentioned.
Yeah, and when I usually will encourage companies, if they're starting out, to think about their model and their approach from multiple different angles. Don't just go, oh, here's my first target market that I can think of. Like, I have this product, who needs it? And then just going with the first one. It's a great opportunity in that, and Harry sort of uses this phrase a lot, go slow to go fast. You'll do a lot of benefit if you sit back, talk to a bunch of consumers. And Edison, I'll just borrow, one of my favorite things that Edison used to do is this thing called the rule of 15. And he would come up with a problem, and he would think of 15 solutions to the problem, whatever question he was asking himself. Is this the right product? Is this the right, he didn't really necessarily target customer, but is this the right whatever? And the first 5 things you think of are obvious. The next 5 start to push your thinking a little bit more. And 11 through 15 start to get a little bit crazy, but sometimes there's just a seed of inspiration out there, like, oh, I hadn't thought of that. That could be a good exercise to do with your leadership team. Push yourself. You may come to the conclusion at the end that where we wanted to go was the right place to go initially. But sometimes I found companies realize that 4th or 5th group out there might be the right place to go after. The other thing is, I've seen companies focus sometimes too much on the largest addressable market, whereas it's that, going back to that cost of acquisition, is there a short-term near-in market that is in that not aspirin category, what was it?
Oxygen.
Oxygen. The oxygen. Sometimes there's a group that's only 5% of the market, but they're the oxygen audience, and they're going to absolutely need this. This is critical, and their rate of adoption and their cost of acquisition and conversion rates are through the roof. They're the ones that drive it, and then you start to move out to your aspirin and joy. I love that. I just like that. It's mind-blowing. I love that. So it really is thinking, in my opinion, about beyond just who I think wants this. Consumer research is also good too, but I think sometimes people just go right to like, well, do research. I also caution people a little bit about relying too much on consumer research, especially if you're doing like friends and family, because they want to say something nice. You know, it's really hard to get people to be honest. Yeah. And I'll share very briefly the one thing I've done in research, which is fun. You do a focus group and you tell people like, who would I was doing a beverage. Who would like to have this product? They're like, oh, this is fantastic. I would love to. I would drink this every day. This is great. I happen to have some here with me. And, and sell it to at retail. Like if it's going to be on shelf at $4 a unit, say, I've got some I'll sell it to you right now. Well, and you'd be amazed all of a sudden, well, can I get it half off? Well, now that tells me my price is like, just watch their reactions. It's Mark Twain line. There's three kinds of lies, damn lies, and statistics. So the research kind of falls sometimes in that same category. Anything else to add to that one before we move on? I think we had one other question in the back, maybe. Anyone? Oh, yes. Stephanie. Oh, we went back.
Not sure if this is a fair question to ask, but your experiences with the ROI. So as investors, getting down to brass tacks, where do you see these markets, the return on investment, going in this field of CPG?
It's definitely smaller compared to what you're used to in other industries. I would say in the 20s is a good investment return.
Oh, hell
yeah. So I don't know what other industries you're looking at, but this is a low ROI. 10 to 20 is a good number to look.
I guess too. There's probably a lot of startups who make it don't.
Yeah, I mean, this is kind of the beginning, the little higher success rate. Like again, it goes back to like in tech, you'll have a bunch of companies chasing it and a couple of unicorns. And in CPG, you can spread your money in like more than a few will hit. Yeah. I think it's like in the tech, it's 1 in 3 succeed. In CPG, it's probably more. I couldn't get the exact number, but it's definitely because it's the length of stay is also longer. Because the investment is smaller, so people are able to keep it alive longer versus the tech. I think it's.
Let me add a little texture to that. So, like most things in life, it depends. In general, on average, the EBITDA multiples for consumer products companies are not as high as B2B SaaS companies, which are probably at the top, right? So you're maybe looking at 10 to 15 for good exit for a CPG, unless it's unusual and you're probably in the 20s and above for the other. So it's not going to give you those flash returns. However, it depends on what stage you invest in. If you invest at the family and friends stage, you're taking a really high risk, but you're getting in at a cheaper price, and obviously that goes up. I find that if a company has demonstrated market traction, which is usually around Series A, you can get a pretty good bead on their likelihood of success, right? You've got trial, you've got repeat, you've got an understanding of competitive dynamics, you've got an understanding of channel dynamics. So you've answered a ton of questions at that point. And then it comes down to, is the team sharp and can they scale, et cetera. So I think then your odds of success may be pretty darn good earlier in the cycle. Whereas if you're doing life sciences, and the other one, am I going to get FDA approval or not? Am I going to get through the clinicals? My grandchildren will see this in market, right? So I think it's a solid thing to have in your portfolio. It's good for singles and doubles and triples. Home runs happen, but then you got to have something special. Then you got to have secret sauce. Whether it's, I think we'll hear about some of that today, where you've got a unique proposition, maybe a patent. If you're Uncrustables, remember that product? Okay, that was patented. There's only one of those in the market. It's a beautiful thing. It's worth a lot, as opposed to, a copycat of some other product out there.
Gary, what do you
I have something to add.
I think one thing too is when you're evaluating when the company's building their strategy for their go-to-market and their scaling, which we talked a little bit about earlier, some of the challenges with scaling, is really understanding what investors or what acquirers are looking for, especially strategics. And companies I've seen make mistakes where they raise $3, $4, $5 million and they decide they're going to blow it all on slotting fees, which if you're not familiar with slotting, it's basically a bribe to get on shelf in a grocery store. They're going to charge you $75 per flavor per door, blah, 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 blah. And it is a profit center for grocery stores. So people get really excited because so-and-so is putting me in 2,000 doors and it's only costing us, $250,000. And I've seen companies go out and go really hard on sales. We want to capture market share, which is probably, if you're a large brand, that's what you want to do out of the gate because you have unlimited resources and huge budgets. But emerging brands, the strategics and the financials are looking, their ideal scenario that I've heard from especially that next level up, the strategics and the private equity in the middle market, is I want to find somebody who has phenomenal numbers in a 5 or 10% of the market. So it's hard, discipline, but sometimes you do much better if you say, I'm going to own the Northwest. I'm going to be in 500 or 1,000 doors or in one channel. I'm going to stick with online only. You're going to stay focused. And then they look at you and they say, wow, and then put your money in marketing. Don't overspend on sales and underspend on marketing. Get that balance right because you want to show purchase, repeat. You want to show that you're getting traction because what they can do if you're going to sell to a Kraft or a Nestle, or if you're doing a beverage and you want to sell to Coca-Cola, what Coca-Cola knows how to do is roll stuff out really, really well. They don't know how to start, but they can take something that's in 1,000 doors and trust me, like your head will spin how fast they'll have that nationwide. That's what they do best. So don't put all your dollars into trying to gain physical traction when the acquirer is looking at you going, that's what I can do. Do what they can't do, which is to show you've identified a niche and proven a product out. So,
Okay.
Stephanie, wait, one more question, unless there's somebody who's okay. I think we're in good shape.
Deep not wide a little bit. But my question is, prior to the pandemic, there was this philosophy of growing at all costs, and I think it's a much different financial climate now, where the pendulum has swung to be profitable first, or as profitable as you can be, which in CPG, as you mentioned, with slotting fees and all of the other costs can be challenging. So when you're assessing businesses and investing money, like what's the tolerance of cash burn, and how do you size that up, knowing that it is a really expensive business if you do want to grow?
Start with you guys, points of view on cash flow. Gary?
Yeah, go ahead, Bob. Well, when you're in the startup mode, cash flow is an important measure, but I look more at what's the actual margin? Where's your margin at? Because scale helps solve, because you've got so many fixed costs or one-time costs or other kind of costs that over the first year to 2 years, you may bleed. But if you don't have a margin to sustain it beyond that, then you're just going to bleed and bleed and bleed and bleed, and nobody likes a tourniquet. So I like to look at the overall margin, and is there any room in that? And look at that competitive set and alternative choices to know. I have seen way too many times that really good consumer products have died because of margin, and I hated having to have a 40% to 45% gross profit margin at Heinz, but it saves the business.
I believe in growing the business based on the value of the business. Value of the brand. Make sure you have the right brand and the product is sellable. People are liking it before you start thinking about growing your business by taking on the loan and just this hype. Don't go after the hype part of it. Meaning just because you sold in one category or one set of stores, you're going to be successful in every other kind of chains out there. sometimes the niche markets, some products do great, but they don't do well in the other markets. So you have to know, where is it that you want to invest and not take that risk if it's not the right fit.
What when I've been involved in selling consumer products companies, we'll create a P&L that has a line for one-time expenses like slotting. Or if we hired an agency to do a branding project and it costs $300,000, we'll put that there because that's a one-time expense. So it's similar whether it's gross margin or contribution margin, but you want to, gross margin is probably for me the most important measure too, because you're going to have pricing pressures over time. You're going to need to be able to still make a profit, and when it gets more competitive than you think it will, and it always will. So and sometimes the category drives it. There are certain categories that are just, when I was in the cereal business, it was a 75% gross margin. Woohoo, happy days. We could do whatever we wanted, and we did. And then in other categories, it's not nearly as robust. So a lot of things entrepreneurs don't think about. They have a lot of passion for something and they get into it, and then they realize, oh, wait a minute, this is harder than I think. So think about gross margins right in the beginning.
And that can be too, I've done a lot of stuff on the other side, which is advising the acquirers on how to think of the economics. And so the acquisitions are usually reported as a multiple of EBITDA or a multiple of revenues. But the evaluation I've seen more often than not is they're looking at the margin if it were in their system. So they'll look at what margin are you getting and say, okay, if we bought this product, what would our margin be using our scale, their efficiencies, and they have more efficient operations. So maybe you have a 30 margin. Like, well, if we bought this, we could get it up to a 40 margin if we plugged it into our systems. And then you're getting a multiple on basically how many years it's going to take us to pay this out. Yeah. And so a lot of times the calculations on your acquisition price are actually based on the margin, the post-acquisition margins that you'll get. So those are important things to think about too when you're thinking about your sell-price.
I'd just like to add one point. I was talking to somebody who's a young entrepreneur, and I said, did you know before the 1980s, we didn't have VCs. People built businesses to run them. And it blew his mind. He was like, I don't understand. And I've worked with some entrepreneurs since that said, I have a passion for this, but I just want to run this business. I want to give it to my kids when I'm done. That's okay. Do that if you want to do that. And there's ways to fund that. Just don't have a misalignment with your investors that are expecting an exit. And there's some creative fundraising ways to structure funding that don't require the traditional equity investment or convertible notes. So if you have any interest in that, come speak to me, because I'm a big believer that we need to open that door too. That a lot of what built our country was people staying with it. So nothing against, believe me, as an angel investor selling these companies, but just be really clear going in what you want out of it, and it's really about your life.
Great point. Thank you very much to the panelists. I appreciate it.
You and Gary stay up there.
Oh, right. We are now going to change hats.
We've had our vegetable things, and we're about to move into the meat side of the meal. But so we're going to start the pitches in just a moment. But just a word from our sponsor.
A word from our sponsor. So as Ron mentioned, Forstall Piper Martin was not able to be with us. They had a flight that was at 5 a.m. that became an 8 a.m. that became a 9 a.m. and 1 to 3, and they still, last I talked to them, wasn't even leaving till 3:30. So unfortunately, they were unable to make it. Gary and I are talking about them. They were very gracious to be our sponsor for this event, and they are a phenomenal design firm. I've been working with them for 30 years, and we've worked on a variety of packages, and then most recently I did a launch with them. The new team that's come on board has really leaned in on their social media, and they're Boise based, where that's important is they are extremely economical. I mean, there's very low overhead, extremely high quality, and I just did 4 different product launches with them in the past 3 years, and we have one brand that got on track within a year on $8 million. We're getting conversion rates anywhere from engagement rates on social media anywhere from 6 to 23%. So really high quality. So I'm a big fan, obviously. There are a lot of wonderful marketing agencies. There's a lot of wonderful design agencies, but I keep going back to them because every time I go there, I get great results. Here's one that introduced me to them. So
My experience was that they took the time to understand my brand and me and my target, that they became an extension of my own brain. And at multiple times, at several different companies where I used Forstell, Piper Martin, I had to use other design companies because there was a mandate from the top that we had to spread it out. And every single time I did that, it cost me more money, not because their original quote was maybe necessarily higher, but because of the multiple rounds of revisions I had to do because they didn't get it. These guys get it, and they get it really good.
yeah, very strategic. So there's two things. One, there's a QR code up here. So anyone who would like, they'll do a 30-minute assessment, and it's not a, trust me, it is not a sales pitch. You give them something and say, what do you think of our website? What do you think of our package? They will be honest with you and give you advice, even if you go back to your other design firm and work with them. They're great.